Hello everyone. Today we are here to show our in-depth research in the Barron's Bank and Nick Leeson affair. This event has shaken the global financial community, and we hope that by sharing it today, we can gain a deeper understanding of the story behind it, the cause and effect, and the lessons we can learn from it. Our group has 3 members, Rao Fu, Wilson Du, and Terry Mo. Although only 3 of us in the group, we are confident that we will do a good job in the analysis. So, let's get started. Founded in 1762, Barron's Bank is one of the United Kingdom's most venerable and esteemed banking institutions with a rich legacy spanning over 2 centuries in global finance. As a prominent merchant bank, Barron's provided standard banking services like deposit and loans and delved into securities underwriting, corporate finance, and other advisory. Its vast international footprint was evident from its significant involvement in financing key infrastructure projects across the United States, Latin America, and other global regions during the 19th and early 20th centuries. Moreover, the bank was renowned for issuing sovereign bonds for nations like the United States and Brazil, especially in the 19th century. Barron's also marketed its presence in various financial markets from currency trading and commodities to futures and other derivatives, highlighted by the Nick Leeson affair. The early 1990s saw Barron's extend its influence in the global future markets, particularly within the Asian sector, trading instruments like the Nikkei 225, the 10-year Japanese government bonds, and in future were predominant in its portfolio, with major trades executed on platforms such as CMEX in Singapore and the notable exchange in Japan. However, this effort to centralize trading posed significant challenges. Although it underscored the bank's adaptability and dynamism, it brought considerable market risks. Nick Leeson's task was to execute trades on the CMEX. Initially, his activities were profitable for the bank, and he rose quickly through the ranks due to his early success. However, Leeson was given a dual role. He was responsible for the executing transactions and also ensuring they were accurately recorded and accounted for. This dual role created a serious conflict of interest because it allowed Leeson to hide his trading loss without direct oversight. At first, one of the leading trading strategies employed by Leeson was arbitrage, particularly between the future contracts traded on the CMEX and those on the OSE. Over time, Leeson began to make unauthorized speculative trades. When these tradings result in loss, he did not report them. He hid them in the fictitious 5-8 account, thus enabling him to conceal these losses for a significant time. Unfortunately, the Kobe earthquake occurred on 17 January 1995, causing the Nikkei stock index to plummet. However, Leeson bet the Japanese stock market would not fluctuate dramatically and did not accept his loss after the earthquake, finally deciding to continue doubling his bet. Ito and Lin noted that the OSE accounted for 95% of the global Nikkei future market. Thus, against this background, Leeson boldly moved when his bought price were at the bubble peak. Overall, Nick Leeson played a significant role in Barron's Bank bankruptcy. Although Leeson has made a desirable profit for Barron's Bank before the occurrence of Kobe earthquake, it was relatively minuscule compared to what he has lost over the period. Some might wonder what trade he undertook. By Leeson's strategy, he believes taking a massive long position, even in the index downturn, would be able to recover his loss. As presented in the table in the slides, Leeson started to execute their trade actively on the Nikkei stock during the post-Kobe 1995, which exceeded the bank's available trading capital. As a result, Barron's could not meet the financial obligations arising from these trades. It collapse seriously affect confidence in the banking and the financial service industry. Barron's was declared insolvent in February 1995, unable to recover from the financial blow. The Deutsche Bank ING eventually acquired the bank's assets and liability for a nominal price of £1.
Building on Rao's insight, we have grasped how Leeson's action led to the downfall of Barron's Bank. However, before we dive deeper, it's crucial to comprehend the rationale behind Leeson's trading strategies. Let's begin by closely examining financial derivatives. Financial derivatives, like futures, serve a dual purpose. They can be used for speculation, predicting stocks market movements, or for hedging asset risks. However, the misuse of these tools can lead to significant losses. as exemplified by Nick Leeson's case. He misused financial derivatives to make unauthorized and speculative trade, which led to significant consequences. Instead of using derivatives as a hedge, he made speculative trade, betting heavily on the market's direction. When his prediction faltered, he resorted to the doubling strategies, doubling down on positions as price dropped, betting on the information hypothesis that the index persists on a contemporary stage or a lag relation from volume to returns. This approach not only misled investors, creating an illusion of safety, but also pushed the bank close to a point of being too big to fail. Initially, when the market was favorable, Leeson managed to use his 5/8 account to seemingly transform a 6 million losses into profits. But hope, just like that of the desperate gambler trying to recoup losses, led to his downfall. He lost a significant amount of money instantly as the market started to fall, causing the Barings Bank to fail eventually. One key reason the strategy failed was the nature of futures. Futures, unlike options and swaps, are traded over exchange, where the cost of taking short and long positions in such markets are equal. The doubling strategy would not have made any effect in the market since there are no differential costs in acquiring short and long positions. When faced with losses, instead of reporting to his manager to limit the damage, Leeson took the opposite approach. As his performance began to decline, he utilized his error account to offset his daily trades, referring to them as transfer trades. He then executed speculative trades in this error account, further increasing his risk with the doubling strategy. Consequently, this inadequate risk management led to significant losses to both the bank and the market. It's also argued that the downfall wasn't solely due to Leeson. The absence of robust internal controls contributed to the Barings' collapse. Leeson, as the chief derivative trader, had the autonomy to make trade decisions, execute, and settle trades on his own. He reported fictitious trades to both management and regulators, reducing margin costs from CIMEX, all without raising suspicion from any colleague. While Barings Bank's management seemed awed with the unusual profits Leeson generated, they neglected to scrutinize the risks and legitimacy of his activities. This lack of oversight, coupled with the absence of a clear division of responsibilities, enabled Leeson to deceive the bank's leadership and regulators.
In brief, Nicholas Leeson's dangerous trading strategy that showed Barings Bank's collapse emphasized the disastrous consequence of financial derivatives abuse and inadequate risk management and internal controls. Leeson took advantage of the bank's lack of oversight by adopting a risky doubling strategy, expanding his positions as price fell and concealing losses through his 5/8 account. This implies the importance of strict internal controls, transparency of trading activities, and effective risk management to protect financial institutions. In order to prevent future financial failures, companies can adopt a decentralized system and a multi-departmental operating model. For example, the Investment Exploration Department could focus on identifying and researching investment opportunities and reporting them to the Investment Decision Department, which is responsible for making trading decisions based on the data and analysis provided. The Investment Decision Department is responsible for making trading decisions based on the data and analysis provided. The Trading Execution Department is then responsible for implementing these trading decisions. At the same time, the Trading Oversight Department is responsible for reviewing each trade to ensure that it complies with all regulations and the internal guidelines. In addition, the Capital Management Department is responsible for approving and monitoring the firm's liquidity. This model can be seen in Goldman Sachs, the global investment bank, which operates with multiple departments, each focusing on its specific function and area of expertise to ensure sound investment decisions and minimize risk. Leeson's case reviews the critical role and the responsibility of investors in trading. Between 1994 and 1995, when trades in 58 account surged from 2,051 to 96,101, Leeson significantly increased his long position in Nikkei futures in the final stage, accounting for 49% of the March 1995 closeout and 24% of the June closeout. This behavior reflected Leeson's gambler's mentality and doubling strategy. From Leeson's experience, investors have learned the importance of maintaining this discipline, avoiding excessive leverage, and ensuring that investment strategies are diversified, or the risk can be effectively managed and minimized. Leeson's doubling strategy and gambler's mindset illustrates the risk of emotional trading and emphasizes the need for investors to remain rational and objective in their trading decisions, ensuring they are based on comprehensive analysis and sound reasoning rather than emotion. Against the backdrop of recession in Japan in 1990, Leeson opened a long position against the trend and purchased 7 billion of Nikkei futures, further exacerbating borrowing banks' losses. This shows the risk of trading against market trends during market downturns and emphasized the importance of aligning trading strategies with market dynamics. At the same time, when traders make mistakes, they should correct them immediately rather than exacerbate the problem further, as the 58 account demonstrates. This experience highlights the important impact of investors' decisions and behavior in trading on the stability of financial institutions and markets.
So I got two questions for the everything above. If Leeson's trading strategy has been successful, would Barron's Bank have examined his trading strategy more strictly?
If Leeson's trading strategy proves successful, Barings may not immediately subject his trading strategy to greater scrutiny. Success can often blind an institution to potential risks, especially when large profits are realized. The bank may view these gains as the results of skilled trading and expertise, and thus may overlook the high-risk nature of the strategy employed. It is important to note, however, that continued success in high-risk investments may ultimately raise concerns about the sustainability of the trading strategy and the level of risks, promoting eventual scrutiny and review. So from my point of view, even if the case is successful, he will not be able to maintain that for long.
Suppose Barron's Bank investors and shareholders has paid more attention to the bank's trading activities and risk exposures. Would they have been able to identify the act on problems earlier?
If borrowing investors and shareholders have been more vigilant about the bank's trading activities and exposures, they may have detected problems earlier, potentially uncovering irregularities or risky behavior in trading activities. Involved stakeholders may request more detailed reports from Leeson and initiate audits where possible. In contrast, Leeson's activities may have been slightly known to borrowing bank's management. They may have been aware of Leeson's exposures and allowed him to widen the stakes as his only chance of avoiding disaster.
That's everything about our presentation on the analysis of Nick Leeson's case and the collapse of Barron's Bank. Thanks for watching.